This week, we're going to talk about everything you need to know about what an assumable loan is.
Hey everyone, thanks for joining us. We're part of the Hedge Homes group, Michelle and I, and it is our weekly Monday market update. Thanks for joining us. So we're going to get into all the pros and cons of an assumable loan, and we have a very special guest to help us get through that.
I would love to introduce my lender friend, Jason Fleming with Neo Home Loans. Welcome, and thank you so much for coming on and sharing your knowledge with us.
Thanks so much for having me. It's an absolute pleasure to be here.
We've had a lot of people recently talk about assumable loans, and it's one of our top 5 trends that's going on in the Portland market right now. So we thought we just helped people out. What is that? Is it an option for you? Is it not an option for you? So Jason, what is an assumable loan? Let's start there.
Yeah. They've become wildly popular again, at least in conversation, right? One of our biggest hurdles right now is affordability, and that's due to interest rates doubling in the last 12 months. So an assumable loan is almost exactly what it sounds like, right? You can assume someone else's loan. And so most conventional loans are not assumable. Generally speaking, the loans that can be assumed would be FHA, VA, and USDA. So that's kind of like the broader spectrum of what assumable loans are.
So who would this be good for? Who would benefit from that?
Yeah. If you're struggling with just the straight affordability piece of a particular payment for a house that you want, if you found a house that was on the market and it had an assumable loan, there's some pretty significant pros that benefit you there. So you're likely going to get a lower payment. I think what we've seen in the market is people that are offering homes with assumable loans are also expecting to get more for them, right? Kind of the same way that we saw prices go up pretty significantly when rates were really low. We're seeing similar, kind of interactions with prices now, but it could be wildly beneficial if you're struggling with the payment, right? If you could assume someone else's 3.5%, instead of 7, that's a pretty steep savings.
That's a big deal. I guess that's kind of a big pro to doing it this way. So what are some other benefits besides inheriting a really awesome interest rate?
Sure. I think one of the other things that if you study mortgages at all, we always tell people don't look at the amortization of the first few years, right? You really don't want to realize how much is interest and how much is principal in the first few years of your loan. Just stay out of that table when you buy a house, right? So one of the major benefits of an assumable loan is, let's say it's 4 years old. You don't just assume their interest rate, you assume their loan. And so you slide right into that month of their amortization. And that's really, really beneficial. Really, nothing changes. You just become the new owner of their loan.
And all the terms that come along with it then.
Exactly. So it's not just the rate, but it's the place in the loan that you are. And that's where trying to put an actual value on that interest rate is even harder, because the rate is great. But if you're 6 years in, the net benefit is extravagant on that part of the amortization table. So I would say that's probably, right along there with rate as the biggest pros of doing this.
I never thought about that. That's interesting.
Yeah, that's really good. Would this also be good for somebody who maybe doesn't have the most excellent credit? Is that something that
so benefit? The interesting thing is credit in this scenario is basically pass fail. Because you are assuming another loan, nothing about it can change. So if the person that got the loan had credit that was 760 and you have credit that's 680, as long as you qualify for the loan, you're getting that loan. So it could be beneficial in that way as well.
That's cool. That's actually really amazing.
Yeah.
So what are some things to look out for, though, some cons, if you will?
Sure. And a lot of them aren't, cons. It's just, it's not, I'm all about Venn diagrams, right? So you have all these assumable loans and then possible clients. Where they overlap seems to be the struggle, because I think the biggest con is if you've been in a loan for 4 or 5 years in this market, or even 3 years, you might have a $350,000 FHA loan for a house that you bought for $375,000. Well, it's now worth $475,000. And the hardest part about these assumable loans is you have to bridge that gap. So if the house is $475,000 and the loan is $375,000, you have to fill that gap. So you would either need to come to the table with $100,000 down to close that gap, or there are a few places in town where you can get a second, what we would call a piggyback second mortgage to help close that gap. And those piggybacks will go up to 90%. So I would say if we were going to narrow all that down to one con, you essentially in most situations need to have at least 10% down.
Okay. That's big. That's good to know.
There's not a version where, again, I shouldn't say never, if somebody just bought a house a year ago and they're getting out, you might be in there for like 5% down. That might be, all the equity that's there. So I would say that's one con. I think if it's FHA, one of the other cons is you have mortgage insurance. So in the earlier example, you could put $100,000 down and still be paying mortgage insurance. Is it a net benefit? You would need somebody to really dig into it and say, okay, well, I've got the benefit of a lower rate. I've got the drawback of mortgage insurance. I've got the benefit of their amortization. And I mean, for a mortgage nerd like me, it would be a lot of fun to figure it out. But in general, it would be difficult for most people to kind of nail that down. And then I think that brings me to what I think is kind of the third con is you are limited to whoever owns that mortgage. So if you have a relationship with a lender, they could be a consultant of some variety to help you, but you are applying with whoever has that mortgage.
That makes sense.
So there's not a version where I get to help you adopt that mortgage. It's something I'd be happy to walk someone through, but ultimately you're not applying with me or anyone else. You're only applying with whoever owns that FHA, VA, or USDA loan.
Okay, I get that.
I heard that they can take a while. Like I heard that this whole process just to assume is like kind of long. Is that true?
Yes.
Okay.
It definitely, one of the things we're seeing right now is because there's so much fewer transactions, we can get things done pretty quickly, like 3-week closes. We just had a 16-day,
wow.
You can do that. Appraisers are standing by, really waiting for something to do. So it definitely slows things down a little bit because again, it's just a different process than everybody is used to. Mentioning appraisers, they often assuming these loans does not require an appraisal. So that would be a benefit that I kind of forgot about because you're assuming a mortgage and it's unlikely that the value has gone down in any of these markets. The majority of them don't require an additional appraisal. So that's another con. But they do take a little bit longer. And you're just, I always assume if there's no real benefit to a bank, they're probably not moving as quickly as they would otherwise. And since this is a loan they already have, they're just being asked to do a bunch of work to move it to someone else's name. I think that's probably part of why we don't see the same speed that we see in some other transactions. But no, Angela, you're exactly right. It takes a little bit longer.
Yeah, I was in a mastermind conversation with some other agents. There was one that was really trying to do that for one of her VA clients, and she went really, really far into the upper management of the VA. Sure. And they basically said that if that seller was to let somebody assume their VA loan, they would lose their VA credibility. And I was like, well, that's a huge con. Huge con. And the VA one is so interesting because VA loans can be assumed by people that would never be considered for VA loans. So the general public can assume a VA loan. But like you mentioned, the way VA eligibility works is if you don't get rid of one VA mortgage, your eligibility stays tied up and you then either can't buy another VA or you have considerably less eligibility left.
It's pretty complicated, isn't it? Like just assuming this loan is pretty complicated.
Yeah.
So
They were really popular back in the 80s. When rates again were just staggering and it felt like it was people's only option.
Yeah.
But again, in practicality right now, trying to overlap available, assumable loans and people that would benefit, the intersection I feel like it's pretty small. I think it's something that you really should know about if you're listing a house with it, trying to track down those particular clients. And then if you're shopping, just realizing that, like a lot of things in real estate, it sounds better and easier and faster than it is in real life.
Yeah. So true.
So true. Thank you again, Jason. I really appreciate you coming on.
Absolutely.
And this was really valuable information. I think if anybody's thinking about getting creative with financing, and this is one option, reach out to us anytime for more information about it, and we can talk about your particular scenario and walk you through it.
And remember to like and subscribe.
Absolutely. Absolutely.
Thank
Thanks so
you.
much for having me.
Thank you.